Good morning, everyone. Thanks for joining us, and welcome to Stony Brook University's Estate Planning webinar on elder law and estate planning, sponsored by our office, the Office of Gift Planning. We really appreciate you taking the time to be here with us this morning. It's a new format for us in the morning rather than the evening, so we're glad that so many people responded and are here. We're thrilled to have you join us virtually for this important discussion. Before we begin, I'd like to introduce the gift planning team at Stony Brook. I'm Sean Morosi, Executive Director. I'm joined by my colleagues Ashley Federer, the Senior Director, and Carissa Farmer, our Gift Planning Coordinator. Our team helps donors, alumni, and friends who are passionate about Stony Brook make a bigger impact than most of them ever thought possible. By exploring various assets and giving strategies, whether through current gifts, estate gifts, or other creative financial solutions, we help supporters align their philanthropy with their personal and financial goals. We're especially proud to help donors take advantage of New York State's unique matching gift programs that are going through next March. And they're exploring giving through their IRAs, charitable trusts, real estates, and other strategic vehicles. Through planned giving, donors not only create enduring legacies, but also fuel Stony Brook's mission of innovation, discovery, and access. What makes Stony Brook truly special is the breadth of its world-class programs and cutting-edge research. What makes our work unique is that we support every school to university, all aspects of our leading-edge medical center, and cultural institutions like the Stoller Center and the Paul Krasner House. If there's an area of Stony Brook that has been transformative in your life or that you want to see thrive for future generations, we'd love to have a conversation with you at no obligation about how you can be part of its future and leave a lasting legacy here. Now, it's my pleasure to introduce today's speaker, a distinguished leader in elder law, tax, estate planning, and special needs planning, Mr. David Okrand. With over 39 years of experience in both law and accounting, David has dedicated his career to helping individuals and families navigate the complexities of estate and tax planning. His expertise and commitment have earned him numerous prestigious accolades, including the Man of Spirit Award for the Long Island Coalition of the Aging, the Angel of Spirit Award for the Long Island Alzheimer's Foundation, the Leadership in Law Award from Long Island Business News, and most recently, recognition as one of Long Island's top 40 attorneys by the Long Island Herald. David is a sought-after speaker and author, having appeared on Channel 12's Best Years and co-hosted Elder Law and Senior Forum on WEVD Radio. His leadership extends to serving as board member of the New York chapter of the National Academy of Elder Law Attorneys and his recent appointment by Governor Hochul to the New York's Coordinating Council for Services Related to Alzheimer's Disease. He's also served on the Suffolk County Bar Association Board of Directors, as managing director of his charity foundation, and in key roles in the New York State Bar Association's Elder Law section. Beyond his legal practice, David has contributed to numerous nonprofit and professional organizations, supporting causes in healthcare, disability, advocacy, and elder law policy. Before entering private practice, he served as a revenue agent with the IRS and worked as an accountant with KPMG Peat Marwick. A cum laude graduate of St. John's University School of Law, he also holds a distinguished academic record in accounting from LIU CW Post. This morning, Dave will be sharing his expertise on elder law and estate planning, helping you understand how to protect your assets, plan for long-term care, and ensure your wishes are carried out effectively. His insights will be invaluable whether you're just beginning your estate planning process or refining an existing one. A quick note before I turn it over to David is that he'll be taking questions, so please feel free to enter them into the chat box at any time. However, please remember this is a general education session, so if you have any highly specific questions about your own personal situation, we'll be sharing David's contact information with everyone in a follow-up email, as well as recording this presentation the next day or so. Okay, please welcome me in joining Mr. David Okrand.
Oh, wait. Good morning, everybody. Can you hear me now? No? Can you hear me?
Yeah, we hear you, David.
Okay, great. Technology, All right. So good morning, everybody. Thank you for inviting me to speak. It's truly an honor to be able to participate with such a prestigious organization as the Stony Brook Foundation. We have a history with you guys, with clients that have done some very unique personal gifting, and that experience has been great for the families as well as for us. And so I thank you for that. I'm going to put up slides. Hopefully the technology cooperates. Okay. Um, we're good. Everybody can see the slides?
Yep,
Yep, we can see them.
Okay, good. So today I'm going to talk about elder law estate planning. As Sean said, I've been doing this for over 30 years. Our focus is to help individuals protect themselves, their assets, their families, their independence, dignity, control, minimize administrative expenses, and prepare for events that they might see in their future without it becoming a crisis. So I hope the information I give you today helps you. It's actually a great time to talk about estate planning because everybody's sitting around the table now doing their tax returns, right? Which is always a wonderful experience. But in doing that, you're accumulating information, assets, 1099s, W-2s, and you're kind of getting organized as to everything that you have. And when you do estate planning, it's really important to pay attention to all those details. Okay, so this is, the first slide I always put up is my bragging slide. Truthfully, I'm going to brag more about my staff, and so I'll go past this because it's because of the great staff that I have in my office that I get to do all of those fun things. And so we're going to start out talking about the 10 most common mistakes. But before I do that, I just want to group things a little bit. Whenever we do estate planning, we talk about administrative side of it, tax side, and long-term care side. The administrative bubble is if I become incompetent or unable to make decisions during lifetime, how will my financial and medical decisions be made? Upon my death, how do the assets get to the beneficiaries I want in the safest way and minimizing legal fees, litigation, and taxes, right? That's the administrative bubble. On the tax side, it's during lifetime, how do I minimize income taxes, gift taxes, estate taxes, and generation skipping taxes. And we'll talk about that a little bit more later. And then the long-term care side is how do we pay for care as we age in place, right? We know that home care now is somewhere between $10,000, $15,000 a month. For live-in care, nursing home can be as much as $25,000 a month. And so those are real numbers, real impact. How to strategize for them becomes really important. And so we're going to talk about each one of those areas this morning. But let's start off with some of the basic mistakes that a lot of people make, because I see people
David,
all the. Yes.
If I could interrupt, sorry. We've got a couple inquiries. The chat function is not working because this is a presentation. Use the Q&A if you want to ask a question. It'll be forwarded to us and we'll share it with David. So sorry to interrupt, but just wanted to clarify that.
That's right. Give me a chance to get my coffee. So these are things that you should pay attention to even before you go to the lawyer or after you go to the lawyer. We see clients come in with beautifully drafted documents and they're non-functional because they're not implemented correctly. So let's just go through the basics here. We see clients that come in that either have no estate plan or they're missing beneficiary designations. What we mean by that is frequently the husband and wife will name each other, but not necessarily name contingent beneficiaries, or they might name their kids, but not name a contingent beneficiary for the kids, right? Because families travel together. What happens if there's a common disaster and nobody survives? And so looking at that is very important. Also making sure you have current documentation of it is very important. A beneficiary designation is not effective until the third party accepts the designation. So if you have a life insurance and you change the beneficiaries and you submit a form online, that change is not effective until the insurance company confirms it in writing. And a lot of people get that confirmation, they put it in the folder, they don't look at it. And then something happens, you pull it out and you say, wait, who is this person as a beneficiary designation? Because the insurance company got it wrong. So simple things, pay attention to beneficiary designations, check them yearly, get a printout, put it in your file, make sure you thought through all of that. We see clients that come in that don't have any documents, which is a problem, especially in the long-term care area, right? Because when a person turns 18, nobody has a right to make decisions for them unless they designate somebody or a court appoints somebody. And so I have triplet boys. When they went to college, we did advanced directives, healthcare proxy, power of attorney, et cetera, so that while they were away at school, if something happened, I could act for them. I could find out medically what was going on. And of course, and this part they really wanted me to do, pay the bills, right? Um, Anyways, so we see clients that have no documents. We talk to people about that all the time, especially with children. Well, the documents are outdated. Now, that outdated means not that documents go bad in terms of when you signed them, they were signed properly, they were executed properly. So a will signed in 1942 with all the proper execution and supervision is still valid and still good. The reason why I put this here as outdated is because the law changes. And we see wills that come in where there are tax clauses written in the wills that were in the 90s when we had a $600,000 federal estate tax exemption instead of a 14 million. And they're bad. And there is actually some pending bills in New York State, which are proposing to change New York State law so that if you have a bad provision in the will, it'll automatically be changed. Whenever we have law that makes something happen automatically like that, we get a little nervous because usually it works for 10% of the people. So you need to keep on top of these documents. With our clients, every time we do a set of documents for them, they get to come back and talk to us yearly at no charge, and we review everything. So we can keep them current, we stay current with them, and make sure that as time goes, the documents are relevant. The wrong executor, trustee, agent, and power of attorney. And now I'm spending a lot of time on this, but it's really so important to go through these fundamentals. So when you make a decision to appoint an executor or nominate somebody to be executor in your will, or a trustee, or an agent in the power of attorney, or an agent on a healthcare proxy, right? You say, well, I'll put this person in, and if I decide to change my mind, I'll change my mind later. I'm going to take trustee out of that mix because sometimes the documents don't allow you to change the trustee. Our documents typically do build in provisions so trustees can be changed frequently. But this, in some documents, sometimes you can't. And if you have a falling out with that trustee, that's a problem. So let's talk about the executor and the powers of attorney and things like that. Yes, you can change the nominated executor, agent in a power, healthcare proxy anytime you want, as long as you're alive and competent, right? Two requirements. But each time you name somebody, you leave a little bit of history. And so if I do a will today, naming somebody, and then 5 years from now, 2 years from now, I do another will, naming somebody else, when that second will gets probated, if it gets probated, the person named in the original will has a right to be notified that they have been removed and a right to object. And so if you've never named them, you never give them the right to be notified or object. So we always say to clients, be cautious, think it through, be comfortable today with your decision, and don't make that choice based on, well, I can change it whenever I want. Okay. Then we see some failures. We see failure to coordinate living trust and assets. People have living trust, revocable, irrevocable, which is a trust that you create during lifetime as compared to one in your will. And they have all these great provisions in it, but they don't put their assets in. Maybe the attorney put the house in, but they never put any of their investments in. They never changed beneficiaries. So drafting the documents, creating the documents, it's always important to follow through. We see this all the time. We see people that have failed to execute power of attorney with gift-giving provisions. Say, well, power of attorney is a document that names somebody or several people in some manner to handle financial affairs if you can. One of the most important provisions in that is the ability to do estate planning, which requires gift giving. So if I have a husband and wife and they own a house together and husband gets sick, ends up in a nursing home, and now we want to transfer the house to the wife living in the community, if the power of attorney doesn't have gift giving provisions in it, we can't do it. And we might end up in court in front of a judge in a guardianship to do this. And we have great judges in Suffolk County. The process is a very good process, but it takes a while, and it's not inexpensive. And a while, I mean 6 months, 8 months. If you have wills that you are reviewing and you didn't sign, they're meaningless until they're signed. We see clients sometimes come in with drafts of documents that they never completed. So with our clients, typically when we're drafting documents, we go over the documents. We don't send them out in the mail. We go over them with them first. Then if they want to take them home, or have them to look at longer, that's fine. And then we make sure they come back and sign everything. Insurance. If you have a house in a trust, you have to make sure the insured on the homeowner's insurance or the property insurance mentions the trust. If you have homeowner's insurance on your home, naming yourself as the owner, and you put it in a trust and you don't update it and there's a disaster, the insurance company could take the position that it's the wrong insured and refuse to pay out on the policy. Today's world, that's really important. People fail to consider tax impact in estate planning. They fail to plan for long-term care. They fail to consult with qualified professionals. So just make sure that when you're talking to people, whether it's a financial advisor, an accountant, an attorney, that they're really expert in the area. This is all we do. And the nuances and the things that happen on a daily basis are really critical. Okay. So let's turn our attention to long-term care, and then we'll come to tax, and then we'll go back to a little bit of planning and structure. So what type of long-term care are we talking about? So here we're talking about care with people that have or need support with activities of daily living. Somebody to help them eat, somebody to help them walk, help them shower, change their clothes, and so on, right? And the types of care that we see are home care, right? Which is care that somebody receives in the house. Usually it's an aide or a nurse or somebody that's coming in the house to help the person. Daycare, social model, medical model. Social model daycare usually takes place at a senior center. Medical model takes place, either at this. I think there are a couple of standalone medical model facilities, but a lot of times it's in a nursing home. The Long Island State Veterans Nursing Home has a fabulous medical model daycare program, and truthfully, it's a great nursing home. The individuals that are in charge of the Vets Home, Fred Skang and Jonathan Spear, that I've interacted with over the 30 years, are just wonderful people. And when my mom needed a nursing home, that's where she went. That doesn't mean there aren't other good nursing homes, but it's a good place. And the medical model daycare program is great, so that if somebody doesn't want aides in their house, or they need more support than aides in the house, and they don't want to go to a nursing home, they might be able to qualify medical model, which somebody will show up at the house, pick them up, ambulance, whatever, help them leave the house, take them to the program for the day, where they can have social interaction, physical therapy, shower, et cetera, and then come back home at night. And this, depending on the medical model program, can be as much as, I think, 6 or 7 days a week. Then we move to assisted living. This is a term of art today. In here, we have independent living, we have assisted living, we have ALPS, we have enriched living, we have facilities with advanced licenses. But all of this is community living, independent living, right? I like that phrase, because to me, we're all living independently until we're living in a community, right? So then we have assisted living, which most of your assisted livings are really just senior housing, technically, with supports in the facility. And my mom is in assisted living, and it's wonderful. But the true term, assisted living or assisted living program, ALP, is a Medicaid term. And we have a couple of assisted living programs on the island that Medicaid will pay for under the community Medicaid program. And we'll talk about that in a couple of minutes. And then, of course, we have the nursing home, right? Home care, we said 15,000 a month for live-in. Daycare, I think, is somewhere around 400 a day. Assisted living, typically around 6,000 to 15,000 a month. Nursing home, somewhere around 25,000 a month. How do we pay for this care? Well, does Medicare pay for it? So if you're in a hospital, I think it's for 3 days and admitted, right? We have to be careful. So when that little advocacy, if anybody goes into the hospital, make sure if they're going to be there more than just an emergency room visit, that they actually get admitted. Speak with the doctors um, to make sure they get admitted, or at least advocate for them to be admitted. If they're kept on what they call observation status, then if they leave the hospital and go to a nursing home for rehab, Medicare will not pay any part of that rehab. So they have to actually be admitted. If they're admitted and they go to a nursing home for rehab, then under Medicare, the first 20 days is covered 100%. And the next 80 days, there's a $209.50 copayment, which the supplemental insurance most people have will cover that. I will tell you now, NISHIP does not cover that. But a little bit of thought there. So Medicare generally does not pay for long-term care. It's designed, and I'm going to use this very global language because there are some more exceptions to it, but it's really designed to take care of you from a medical, repair, insurance perspective, not to provide long-term aids or pay for a nursing home long-term. So we could privately pay. That's another option. Long-term care insurance. So in today's world, we have two basic types of long-term care insurance. We have traditional long-term care insurance, which is a policy that pays so much a day for so many days for long-term care, right? Which is typically home care, assisted living, nursing home, but each policy is different. And then we have life insurance that will allow you to use the death benefit to pay for long-term care. And we talk to clients about both. It tends to be expensive. The long-term care insurance market right now is tending to be a little difficult because the insurance companies are experiencing that people that bought the policies are actually keeping them and using them. And so they're not making as much money as they thought they were going to, and they're significantly raising premiums and making it more difficult to get the insurance. But it is something to think about, talk about. We always suggest that that's something you do with a financial advisor, and then we come in the mix to fill in the conversation so that we can look and see what's the advisor recommending, is the advisor recommending, and maybe there's insurance and Medicaid planning combined. So it's one of the items at the table to look at. And then we reach Medicaid, right? We have Medicare, private pay, long-term care insurance, and the last resort right now is Medicaid. Medicaid is a program that was instituted in 1965 by the federal government when it said to the states, you need to have a medical program for the poor. And when they said poor, they meant poor. For a single person to be eligible for Medicaid, if they're in an institution, they're allowed $50 a month in income and $32,396 in non-qualified assets. If they're at home, they're allowed $1,800 a month in income. However, there's a technique that we established, when I say we, the Elder Law Bar a number of years ago, referred to as a pooled income trust, which is really a trust that you join when you go on community Medicaid, and you can take the excess income and transfer it to that trust, and then use the money in that trust for anything Medicaid doesn't pay for. So if you have $5,000 a month of income, anything over that $1,800 would go into that trust, and then it can be used to pay for anything Medicaid doesn't pay for. So we get to protect all the income in the community. Okay, step away from that for a second. Let's just talk about retirement accounts and Medicaid. So Medicaid, a colleague of mine, Albany, won a lawsuit back in the 90s, federal circuit, and was able to establish that retirement accounts are not considered available assets for Medicaid. So what does that mean? They're ignored. So IRAs, 401ks, 403bs, Roths, when you go to apply for Medicaid, if a monthly distribution is coming out of that retirement account, Medicaid will ignore the balance in the retirement account and just count the distribution as income. And so a lot of people say, well, then the retirement account is exempt. Well, not really, because if you're 92 years old, the table, the life table to determine the amounts coming out monthly is like 3 years. So the whole thing's going to pay out in 3 years. You're going to lose it anyways. point is that when we do planning, we look at the retirement accounts and we consider, do we need to terminate them? Should we keep them? Are they exempt? How we're going to factor it in. So, point of interest, you can have a prepaid funeral for yourself, which you can do up until I think 10 days after you apply for Medicaid. And you can have a prepaid funeral for family members, but that has to be done before you apply for Medicaid. So there's a thing to consider. Christmas time, you could prepay funerals for your kids. Just kidding, of course. Medicaid in the home. All right. Everybody thinks the home is exempt. And the truth is, sometimes it's not. All right. The law changed in 2006, where they put a cap on the equity that could be protected in a home. New York, and this was a federal law change, and they gave a range to the states. They said you could pick a number between, this and this, and New York picked the highest. That number has now been inflated, so the equity in a home can be up to $1,097,000. So if you're living in your home and your house is worth $800,000, $600,000, and you have no mortgage, it's exempt as long as you're living in it. Okay. If you leave the house to go to a nursing home, it's not exempt anymore because you're not living in it. If you die, it's not exempt anymore because you're not living in it. Under both scenarios, well, let me go. So under the dying scenario, Medicaid can recover everything they've paid out of that house, paid out for you from that house through a probate estate. So we have clients that have come in that they went on community Medicaid, they got aides in the house, and they left the house in their name. And we immediately took the house out of their name and put it in a trust or did something with it. Because if the person at home died, they'd have to give all that money back to Medicaid. Okay, so clarity here. Everybody thinks the home is exempt. I just want to leave the thought that the home is exempt if its equity is under $1,097,000 and you're living in the house. Otherwise, it is not exempt. If you have a spouse, then there is no limit if the spouse is living in the house. If a child under 21 or a child certified blind or disabled, then there's no limit on the house. We've actually suggested at times to people get married, but everybody always says no when they're 87. They say, no. Okay, so now let's talk about married couples, right? And we're going to start with community Medicaid, then we'll talk about nursing home Medicaid. So the rules change a little bit. They're similar, right? But they change a little bit. So we have one applying for care. Mom needs care, dad doesn't. We're going to look for Medicaid to pay for care in the house, have aides come in, right? Dad can have a house of any amount. The applicant is subject to the limits, but dad's living in the house, so it's fine. The applicant can have the $32,396. The spouse can have between $74,820 and $157,920. And there's this technique. So if the spouse has more than that, called spousal refusal. So if the spouse has $500,000, not in a retirement account, and we want to go on Medicaid, then the spouse has to refuse to make that excess available. Medicaid has to pay for the applicant. Medicaid can go to that community spouse and require them to repay them up to that excess. So spousal refusal technique is something we use in a crisis. We don't plan for it. In this slide, it shows that you can have unlimited amounts again in tax qualified retirement accounts. That's the IRA, 401k, 403bs. Be very careful with annuities. In 2006, Congress decided or determined that the country was using balloon annuities in a way that they didn't like for Medicaid. So people were taking $1 million at age 90, putting it in an annuity that required a payment of $100 a month back to the applicant, and then a balloon payment of whatever was left, million plus, 30 years later. And Congress said, that's abusive. We're going to treat that type of transaction as a gift. We're going to ignore the value. We're going to say that the applicant didn't get value for that annuity, and therefore it's really a transfer because it kind of looks like it. 30 years, 90-year-old, $100 a month. Yeah, it really looks like a gift. And so they created these rules regarding annuities, that if you have annuities, they mandate that a spouse can be named, and then the state has to be named after the spouse. If there is no spouse, then the state is named. So in certain circumstances, if you have an annuity and you go on Medicaid, you've got to name the state as the beneficiary of your annuity. And trying to get out of annuities after you've been in them for a while can be a tax nightmare. So if you're using annuities and you're planning with annuities, which are very appropriate in certain circumstances, be mindful that there may be a conflict with Medicaid planning and tax planning, and so be careful with that. Monthly income. So again, we're still talking about one applying, one not applying, right? Mom, I forget who I picked to need services. Let's go back. Let's say mom needs the services and dad doesn't, right? I think that's what we said. So the combined monthly income is $45.81 a month. That's the exempt amount. Applicant can have $633. The spouse can have $39.48. We can use a pooled trust. We can use spousal refusal. We decide that when we're putting the application together. If both are applying, then the numbers change again. Now a house is subject to the $1,097,000 limit. Retirement accounts are exempt in pay status, and they can have combined assets of $43,781, income of $24.33, pooled trusts. When you go on community Medicaid, there are a couple of programs that you can access to get services. So Medicaid is insurance, like any other insurance. Well, not really, but let's liken it to it. And now you're on Medicaid, and now you say, okay, I need services. I can go to doctors that take Medicaid. I can go to home care agencies that take it. I can go to certain programs, right? In New York, we have the NHTD, Nursing Home Diversion Waiver Program, which is a program that is paid for by Medicaid that you can get 24-hour care through. A governor is currently thinking about limiting the number of people that can be on the program because it's become so popular that it's kind of blowing up the budget. So the NHDT program. But I think today I want to talk a little bit about PCA and CDPAP. So you can have aides from a home care agency, or you can hire your own aides, and then have them paid by Medicaid. That's called the CDPAP program, Consumer Directed Personal Care Assistance Program. And this is what you're seeing TV ads about regularly. One side is saying the government is taking away the Medicaid, the home care aides. The other, the government is saying we're not taking it away, we're trying to make it better. And so for clarity, what's happening here is that this program also has become very popular. And traditionally, our local home care agencies administer the payroll and some services with the aid. So you go on Medicaid, you pick your aid, you go to a local home care agency, and they process the payroll. And a few other things supervising. And so the governor identified that we had too many, I think we had 600 home care agencies doing this in New York, too many, it was costing the state too much money, and decided that, or the Department of Health with the government, they decided that they wanted to have one agency, one fiscal intermediary managing all this. And so that was put into law, I think last year, supposed to be effective April 1st this year. The governor just, I think, postponed it for 10 days because the transition, is a little bit challenging. And so this is what's happening now. She's moving from local agencies to this one company called PPL, and trying to get everybody, all the aides paid through this one agency, fiscal intermediary in New York. And as part of the process here, came to realize that there were some problems. She's identified some local agencies that are acting as subcontractors, and so this is current. It's happening as we speak. Those of you that have aides at home through the CDPAP program, you need to pay attention to what's going on, because if you don't, your aides may not get paid, or you may lose your aides. So I just wanted to highlight that a little bit, but I digress. So nursing home, the married couple, right? So now if I have one in the nursing home and one at home, community spouse, institutional spouse, the applicant can have the $32,000 retirement accounts. Be careful with annuities. Community spouse can have a home of any value, again, between $74,820 and $157,920 tax qualified accounts. Be careful with annuities again. The real difference between this and the home care is the applicant only gets to keep $50 a month of their income instead of the $633, and the spouse gets the $39.48. No pooled trust in a nursing home. We can't shelter excess income. We can use spousal refusal, though. Okay, transfer assets in the 5-year look back. This is always interesting to talk to people about because a lot of people get confused with this. This only applies, the 5-year look back only applies in an institutional nursing home setting. Just looking to see the time, we've got a bit to go. So if you're applying for community Medicaid, medical model daycare, nursing home diversion waiver program, CDPAP, the 5-year look back doesn't apply in New York at the moment. Under Cuomo's administration, they put in a rule with a 30-month look back that was supposed to take effect October 1, 2020. It has not taken effect. It was postponed because of COVID, and it has continually been postponed. And there are bills pending now to actually repeal this. But what we're telling clients is if you need Medicaid and you need community Medicaid, or you could use it, apply now, because if this law goes into effect, there'll be potentially a 30-month look back, but it'll only be for new applicants. Okay. So the 5-year look back rule works like this. When you apply for nursing home Medicaid, you have to give them 5 years of records. If they find that you gave away money in the 5 years, and giving it away for Medicaid means you can't explain where it went, right? So you gave away money during the 5-year window, and that money can't be justified, right? That for some purposes other than it was a gift or can't be explained. And so for Medicaid eligibility purposes, for every $14,914 on Long Island, it's a Long Island number. New York City is a little different, and some of the other regions of the state are different. So for every $14,914 you give away, you're not eligible for Medicaid for 1 month. So if I made $1 million transfer and I apply for Medicaid in month 61, 5 years and 1 month later, the transfer is gone. Nobody cares. If I apply for Medicaid in month 59, I'm not eligible for Medicaid forever. And then I might have to reapply, or I might have caused a problem. So you need to be very careful when you apply for Medicaid that you don't apply during the wrong time period. Okay. So the 5-year look back primarily applies in a nursing home setting. And we talk to clients about this all the time. It's a good idea to get ahead of that. We're going to talk about using trusts in order to do that the safest way. I love this slide. Medicaid is absolutely amazed. There's a lot of options. My team is very good at this. And so for 30 years, we've helped clients navigate through this a lot. And so I like this slide. Okay. Let's talk about Coordinating Council for Alzheimer's Disease and Dementia. It was my honor last year to be appointed by the governor to this council. It was established by the Public Health Law 2004A, and it was created to facilitate interagency planning, policymaking, review agency initiatives, et cetera, and focusing on the impact of care for persons with dementia and their families, and provide a forum for discussion. The council is charged with providing periodic reports to the governor and the legislature. We actually are going to issue a report, hopefully this year. We have a urgent meeting the end of April to finalize and issue that report. And the report is very informative. It goes through the state of medicine regarding Alzheimer's dementia, programs that are available, funding that is available, and it is a collaboration by the members and the Department of Health that pull it all together. So it's really a very good document. I'm looking forward to putting it out. One of the things I just wanted to highlight for everybody regarding this is the BOLD program. The federal government, this is a federal government initiative, and it's the Building Our Largest Dementia Infrastructure for Alzheimer's Act. It was signed into law in 2018, and it's designed to support a public health approach to prevention, treatment, and care of people with Alzheimer's disease and related dementia. And it authorized the CDC to establish public health centers of excellence dedicated to promoting the best ways to effectively manage Alzheimer's disease, related dementia, and support caregivers. And the reason I mention this is because we are very fortunate in that Stony Brook has been identified as one of these centers for excellence. Our clients have had the opportunity to interact with them. It's been very successful for them. The care they receive, the professionals there are wonderful. Can't say enough good things about it. So I wanted to highlight that for everybody. It's something for us to be proud of. Authorizing the CDC also to work with state local health departments to promote brain health strategies to reduce cognitive decline for the people with ADRD, improve analysis, timely reporting of data. And states with more developed programs like New York are expanding focus on early detection and diagnosis. And there's some very exciting things happening in that field. And so it's been my privilege to be on this council and be in the room with some of the most intelligent, kindest people that I've met. Okay, let's talk tax. So we're going to talk federal estate tax. We're going to talk about New York estate tax. So the federal government has its own estate tax, right? The exemption in 2025 this year is $13,990 per person. That is set to go to $5 million on January 1st, 26, unless Congress acts. So last year before the election, the conversation in my world was if the Democrats get back into office, then this might go down to this $5 million subject to inflation, and we might be looking at $7 million approximately per person. And with the Republicans in office, the question becomes, is it going to go up? Is the estate tax going to be eliminated? Or maybe they'll leave it alone because they don't need to use any political capital to mess with it, and maybe the number is high enough. So we really don't know, and we're watching this very closely. So currently, an individual can have 13,990. Married couple doubles that to 28 million with good planning. Important. The annual exclusion in 2025 is 19,000. This is the $10,000 amount that everybody thinks of. It's now 19,000. By the way, this is tax only, not Medicaid. Medicaid has no exemption. You give away $100, you divide 100 by 14,000 and change, you come up with a number of days not eligible, right? I've given you a couple of other things regarding if a spouse is not a citizen, then the maximum you can give to that non-citizen spouse is 190,000. And then if you are the recipient of gifts from foreign persons in excess of 19,570, that has to be reported. Clawback. So I put this here because when the basic exclusion amount was increased, which is what's set to come off, right? The 14 million that we just talked about is really two pieces. It's the original exclusion amount or the basic exclusion amount, and then there's an increased piece. It's doubled. So we have two 5 millions. Both are inflated up, right? Getting us to 14 million. So the piece that's going to go away is the increased piece or the second piece. So in 2019, everybody was concerned that if they do estate planning and they use the second piece, which in order to use it, you got to use the first piece also, but we'll talk about that in a minute. So let's say you gave away 14 million and the law sunsets now, and we're back at 7 million. The question became, are we going to have a tax on that excess that we gave away now or on death? And so there was a lot of conversation. And so the IRS issued regulations in 2019 referred to as clawback regs, meaning clawing back the exemption. And they said, generally, if you use the exemption that's in place at the time and you do it without any retained control, strings attached, then it will not get clawed back and you will not get taxed. So if you give away 14 million today and the federal exemption goes to 7 million next year, you have locked in your 14 million and you will not be subject to the tax on the excess. Okay, let's talk about New York. Every state has their own rules regarding estate tax. Some estates don't have it. Some estates have an inheritance tax. Some estates have a tax based on relationship to the decedent. New York has an estate tax that's very similar to the federal tax. However, it's not tied to the feds. So if the feds repeal the exemption, reduce the exemption, it doesn't affect the New York exemption. The New York basic exclusion amount right now is 7,160,000 with a top rate of 16%. New York has no gift tax at this point, but if you die within 3 years of making a gift, any gift you've made gets pulled back into the estate. That was set to sunset, that look back or that gift piece was set to go away January 1, 2026. In the governor's Article 7 budget bill now pending, she's making that 3-year look back permanent, or I should say the state looks like it's going to make it permanent. We have no portability. What does that mean? Well, under federal law, if you're married and one spouse dies, the surviving spouse can take whatever's left of the deceased spouse basic exclusion amount, roll it over to them. So if they didn't use any of it, the surviving spouse can have 28 million, right? We don't have that in New York. In New York, if a spouse dies and they haven't properly used their $7 million exemption, it goes away. So there are planning techniques that we use called credit shelter planning, where the first to die can leave assets in trust for the survivor, use their exemption so that their 7 million gets used, and then the survivor uses their own 7 million and we double it to 14 million. But you need to be ahead of that. In New York, if the taxable estate exceeds the 7,160,000 by 5%, or if it's 105% of the 7,160, which is now 7,518,000, you lose the exemption completely and you have a 16% estate tax. So if your estate is 8 million, you have no exemption in New York. If your estate is 7,160,000, there's no tax, a full exemption. And so that provision in the law has caused us to be creative, and we use cliff planning by something called the Santa Clause. And here's an example where we can benefit charity, benefit family. So let's say I have an estate of 7,260,000, right? Nothing goes to charity. So the net is 7,260,000. The estate tax in New York is $262,535, leaving the family with 6,997,465. Let's say instead we have a provision in the will that says the survivors can disclaim, or in the event my estate is more than 7,160,000, then less than 7,518,000, then that difference can go to charity. There's a bunch of different ways to do it, and we name Stony Brook Foundation as the charity, right? So here we take the same example. I've got 7,260,000, 100,000 goes to Stony Brook Foundation, 7,160,000 is the net. We just eliminated the tax, and now the family ends up with 7,160,000. So we saved 162,000 in tax as it relates to the family, right? So the family got 162,000 more, and Stony Brook Foundation got 100,000. So we did something good in the community. This is a wonderful option for people to consider. When we talk about, I put this here, when we talk about New York estate tax, New York taxes a resident of New York on the personal property, intangible property, and the New York real estate. Okay. Intangible property is stocks, bonds. If you own a corporation, it's the stock of the corporation. If you own a limited liability company, it's the interest in the limited liability company generally, right? So if you have property, if you own real estate in Florida and you're a New York resident and you die, that Florida property is not included in the New York taxable estate. But if you took that property and you put it in an LLC with let's just say you have it with your brother, and you both own it, the LLC, and it's Florida property, because it's now an intangible limited liability company, now it's includable in your estate. Whereas if you owned it as real estate, it wouldn't be. So this is a ruling that New York State came out with and basically said, if it's a single member LLC, they'll ignore the LLC. Otherwise, they treat it as intangible. And we have clients that have property. One client's got property in Vermont, and other clients have property in different states. And some of the Vermont property is farm property, so it's in an LLC, and we're trying to figure out a little bit for him how to get around getting it and keeping it out of New York estate. Okay, beneficial ownership. I'll just talk about this quickly. For those of you that have businesses, Corporate Transparency Act required that anybody owning a business that was formed by a filing in the state, like a corporation, S Corp, LLC, family limited partnership, had to file with FinCEN the entity and the individual owners. And if you didn't, it was up to a $600 a day fine and 2 years in jail. There's been a lot of litigation over this. constitutional challenges. FinCEN just came out and said it's only going to apply to foreign entities. So we really, for the most part, we don't need to worry about it. But if it's a foreign entity, then it does have to worry about it. Next year, New York State has a limited liability Transparency Act that if you own an LLC, you are going to have to file with New York State the entity and the ownership, and that becomes an annual filing. Okay, whenever we talk about tax, we need to talk about income tax, right? And I like to do the comparison between trusts and individuals. So a lot of people are doing trusts, and we have to be careful that in doing a trust for estate planning, we don't, to minimize estate taxes, avoid probate, et cetera, we don't end up generating an income tax. Trusts and estates get to the 37% income tax at $15,650 of income, where I'm just going to flip to the next slide, where individuals get to that threshold at $626,000. So if we're doing a trust, we want to make sure that the income of the trust is taxed to the individuals. One of the ways we do that frequently is we use this thing called the grantor trust rules, which were put in place by Congress in the 70s when people were putting assets in trusts, because in those days, individuals were in a higher tax bracket than trusts. So people would put assets in a trust, let the trust pay the tax, and then take the assets back. So there's a whole series of grantor trust rules that we access frequently so that the trust doesn't become its own taxpayer. It gets taxed to the creator of the trust, and we get to use these rules. And we keep capital gain exclusions and other things that we'll talk about in a couple of minutes. Here's the Tax Cuts and Jobs Act of 2017. This is just a list of some of the items that are now set to expire that the Congress is working on continuing, expanding, and altering. So I just put that here so that we would have it. I remind everybody medical expenses are deductible. My mom is paying for her assisted living and some care, and the portion of that care that is tax deductible because it's medical, we're paying for it using her IRA and getting an offset. So I like to talk about that. You can't talk about income taxes and estate planning without talking about the Secure Act. In 2019, the Secure Act was signed into law, took effect January 1. This is the act that changed how you inherit an IRA or retirement plan. And before this, if an individual inherited a retirement plan or a trust that was a see-through trust that looked like an individual, then you could have a life expectancy payout. So we would leave IRAs to 21-year-olds, and we would see, with interest rates at 5%, we'd see a 20-time growth. You had to leave $1 million to a grandchild at 21, that's worth $20 million over life expectancy. So obviously, because of that, Congress said we need revenue. They changed it, and they put this 10-year payout in instead of life expectancy, unless you meet one of the exceptions. So the exception is if the exceptions basically are if the person inheriting it is a spouse, chronically ill, disabled, minor child, or an individual that's older than the decedent, then you can continue to use life expectancy. Anyways, so this 10-year payout has become conversation. If you name an estate or the wrong trust, it could make it a 5-year payout. So you need to be very careful. We are very carefully planning with this. The IRS in July of 24 issued final regulations. They're good regulations, especially when we're dealing with families with special needs. And you want to leave an IRA to an individual with special needs. You want to leave that in a supplemental needs trust, special needs trust, which is a trust that for that individual can have assets, but they can stay on government benefits. And so now under the Secure Act, it defines that trust. It says how to do it. And so it's really important to follow those rules. And so I think that's all I want to say about this at the moment, but it's important. So this 10-year payout really kind of changed the landscape, right? Instead of having this $1 million that could stay there for 20 years and grow to 20 million, we got to pay it out in 10 years. So we started to look at alternatives in doing that. And so charitable alternatives are always interesting when you're dealing with income taxes and appreciated assets. And there's a lot of really interesting creative stuff that we can do that benefits charities and families at the same time. This slide illustrates if I have a $600,000 IRA and I leave it to a child, compared to if I leave it to a charitable remainder trust for the child. Charitable remainder trust is a trust that during some period of time, in this illustration, 20 years, an individual gets a benefit, monthly, quarterly, something's paid out to that beneficiary. And then upon the termination of the trust, whatever is remaining in the trust will go to a charity, like the Stony Brook Foundation, right? So here, I illustrated this back in 2022, just to show the comparison, right? And the numbers would be different now, but similar, because the interest rates that I used would be going up or down simultaneously. So here I have a child receives 600,000. They withdraw it in the 10-year window, pay the tax necessary, and then reinvest it for 10 years. At the end of the 20-year window, they'd have $1,000,001. If instead a charitable remainder trust was used, the child would get over 20 years $1,415,000. The charity would get 293,000 for a total of $1,000,007. So those numbers are interesting. Not for everybody, but it's definitely something to consider. Qualified charitable distributions. This is important. Income tax planning. If a taxpayer is 70 and a half and older, you can transfer up to 108 annually from your IRA to a qualified charity like Stony Brook Foundation. For those 73 and older, that distribution also qualifies for RMD. Oh, and it's not recognized for income tax purposes. So if the 108,000 goes directly from your IRA to the Stony Brook Foundation, it doesn't go on your income tax, and thereby causing your Medicare Part B to be more, et cetera, et cetera. I caution you two things. It doesn't apply to donor advised funds. The IRS is now looking at donor advised funds. They have proposed regulations out there. Donor advised funds are good things, but the Treasury is looking at them, and they are concerned that they are being abused a bit. And so if a financial advisor is recommending them getting compensated incorrectly, there can be very significant excise taxes that can hit. So just be careful with the donor advised funds when you're thinking about them. Okay, moving forward, for those of you that are in the crypto space, if you want to donate crypto, you can, but you need an appraisal. If the value of it is 5,000 or more, or the deduction is 5,000 or more, you need a qualified appraisal to establish that, or the IRS will disallow the deduction. I'm not sure what a qualified appraiser is, right? So that's an ever evolving problem, finding somebody that's qualified to appraise that. Here's a list of some tax planning ideas that we use in 2025. So it really comes down to some gifting and spousal joining in on things. So you could gift, if we can gift up to the 7 million. If we want to make sure that we preserve the 14 million, you got to give away more than 7 million, because when you make the gift, it uses the first 7 million. And then that extra piece that is added on that's set to go away, to get to that, you have to exceed the current piece and go up. So outright gifts, we don't like outright gifts. We like trusts, because we're always concerned that the person we're giving it to could get divorced, could become disabled, could get sued, could file bankruptcy. So trust can protect assets, even in the event of a beneficiary having those issues. We see that a lot in our estate plans, leaving stuff to kids. We're worried they might get divorced. Leave it in a trust for them. Let it be a beneficiary control trust. They can manage their own assets. Do it all the time. We have spousal trusts. We have split gifts where one spouse makes the gift, the other one joins in. Use business entities to transfer assets. Generation skipping tax planning, we don't have time for today, but if you leave things to your grandchildren and it's more than 7 million, or 14 million, I should say, you could have not only a gift tax, but you could also have a generation skipping tax because you bypassed your kids. If you use the exemption in prior years, the exemption is up now, you can make more gifts and review your documents. And I'm going to move forward from here. Last year, the governor put something in the law, or the legislature in New York, governor signed it into law, called the Transfer on Death Deeds Act, which allows you to put beneficiaries on your deeds. We do not use this. It's terrible. So you can record a deed in the county and say, on my death, this will be my beneficiary. The problem with it is you choose to change it, you got to record another deed. That's just one of the problems. The other problem is you can't say what happens if the beneficiary dies, like you can in a will or a trust. It's just very limited. We really don't like it, and we're afraid that people are going to use it because they think it's simple, and it's really has the potentials to be a disaster. So just be very careful of the transfer on death deeds. My favorite tax slide, a new method of taxation. Today we're introducing a simplified tax code. Send us all your money, we'll send you back whatever we don't use. And some quotes. Ronald Reagan, the taxpayer, that's someone who works for the federal government but doesn't have to take a civil service exam. Albert Einstein, the hardest thing in the world to understand is the income tax. Morgan Stanley advertisement, you must pay taxes, but there's no law that says you got to leave a tip. And my favorite, Will Rogers, the difference between death and taxes is death doesn't get worse every time Congress meets. Veterans benefits. For those of you that are a veteran or have family members that are veterans, if you have a medical expense that exceeds your income, you can get assistance from the Veterans Administration. Gary Richard is a veteran service officer in the Suffolk County Veteran Service Agency. He sits at the Vets Home. It's provided his services, and the agency provides services to veterans. There's no cost. We recommend that if you're a veteran, you go see him or another veteran service officer in Suffolk County to see what benefits are available to you. It's always good to explore that. Advanced directives. Now let's go back to administration and talk about planning. And we're going to talk about planning in the long-term care concept, Medicaid planning, right? So advanced directives are documents we do in advance of an event, right? If you have a stroke or an event and you become incompetent, you can't do a power of attorney. At that point in time, the only thing you could do is a guardianship proceeding. And at the bottom of the screen, we talk about 17As and 81. 17A is a guardianship for an individual who is, let's say, disabled prior to the age of 22 and unable to make their own medical or financial decisions. Article 81 is a proceeding in the law for everybody else. And so you have no power of attorney, or your power of attorney is not done right, no healthcare proxy, whatever. We have to go to court and have a guardian appointed. And that is a process. So if you want to avoid that process and you want to be in control of who is going to make your decisions, right? Because if you end up in court, the judge decides who's going to make your decisions. They're going to appoint somebody and supervise, right? And it tends to be a little micromanagement. So it's not very flexible. You don't just get appointed a guardian, now you can do whatever you want. You have to report to the court yearly, and they have to approve what you've done. And so again, we have a great court system, we have great judges, but the supervision is heavy. So do a power of attorney. Name the person that you trust to handle your financial affairs. If you are unable to, you can have multiple people. You can require them to act together, act individually. I put trusts in this category because if you have trust and you put assets in it, then the trustee of the trust manages those assets, and the power of attorney manages assets outside the trust. You should always have both. For medical, you want a healthcare proxy, living will, MOLST. We'll talk about the Family Healthcare Decision Act and the CARE Act. Healthcare proxy law says you can appoint an agent and a substitute, not 6 people, right? So why not do a healthcare proxy? That healthcare proxy should also identify life-sustaining wishes. If you do not say what your wishes are regarding artificial nutrition and hydration, the healthcare agent does not have the authority to act on that. So it's important to have a healthcare proxy. We've had people come to us and say, I don't want anybody to make my decisions. And my answer is, if you don't appoint somebody under a healthcare proxy, somebody's going to end up making your decisions. It's just not going to be the person you choose. It'll be the person the court chooses, right? So the healthcare proxy in New York is the operative document. A living will is an expression of wishes. It's basically a letter to a court or a judge saying, if I'm terminally ill, I don't want life-sustaining measures. Our documents usually require 2 doctors, terminally ill, no hope of recovery, and we want all the pain medication we can get, et cetera. So they work in conjunction. It's good to have that because maybe you're in a country that doesn't recognize the healthcare proxy, or maybe the 2 people that you've named in the healthcare proxy, the primary and the substitute, maybe they're unable to act for some reason, and now the living will expresses wishes, and you can make sure you don't end up on machines artificially if it's something you don't want. The MOLST, Medical Order Life Sustaining Treatment Form. You can pull that down off of the Department of Health website. It is kind of like an advanced DNR. EMS will not follow generally a healthcare proxy or a living will. They show up at the house, you show them the healthcare proxy, they say, we're not obligated to follow. They are supposed to follow a MOLST. And that is a document that's filled out between patient and doctor, use the state form. And EMS is trained to look for it. It's supposed to be on the refrigerator. It's really designed to be for long-term care. We recommend everybody look at the document, talk about it with the doctor, because it gives you opportunity to have very meaningful conversations about end of life treatment. By the way, there's a bill pending in New York on end of life that maybe will pass this time. We'll see. But it is assisted suicide. I'm sorry, medical assisted suicide pending in New York. Family Healthcare Decision Act says if you end up in a hospital and you're incompetent, a committee can determine you're incompetent and then allow a person to be appointed to make decisions for you. The CARE Act lets you designate somebody else to be at a discharge planning meeting with you. So you're in the hospital and you're going to get directions on what to do when you go home. You have the right to designate somebody to participate in that meeting with you so that you have somebody else to, to help you when you get home. So that's a good thing to have, especially spouses be involved in that. Okay, let's just talk about method of protecting assets for a minute. Again, we're going to focus back to long-term care. We have outright gifts, life estates, and trusts. So this is a transfer matrix that I came up with, I think in the 90s, and I keep using it because it really is, I find it's very illustrative and helps talk about all the issues when making a gift, right? So let's take your house. You take your house, you want to protect it for, you're thinking about long-term care and you want Medicaid to pay and you want to start the 5-year window. And so just focusing on that, I take the house and I outright gift it to the kids, right? And so for Medicaid purposes, I still have a 5-year look back to outright transfer. From a tax point of view, I lose my STAR exemption, my veterans exemption. For the firemen's in the room, you lose your fireman's exemption. Capital gain exclusion, right? So if you've lived in your home for 2 out of 5 years and you go to sell it, you get a $250,000 capital gain exclusion. If you're married, it's $500,000, right? If you give this to the kids, you lose that exclusion because generally they're not living in the house. And then there's this thing called the step up in basis. So when you inherit an asset, like a house, under the tax law now, that asset, the recipient receives the house and their cost basis goes to date of death value. So if the house, you paid $20,000 for the house, they inherited it's worth $600,000, they go to sell it, their cost basis is $600,000, not $20,000, and they have no capital gain. One of the things that we're concerned about is if they repeal the federal estate tax, they'll repeal this. And that would be a very significant tax impact for most people. Anyways, if we outright gift the house to the kids, you're giving them your cost basis, and they lose that step up in basis. So from a tax point of view, the outright gift is not great. From a lifetime protection point of view, not great. You give the house to the kids. What if one of them dies? What if one of them files bankruptcy? What if they get divorced? Now your house is in jeopardy. So you've lost control. You've lost your independence, your dignity, your freedom. So we don't like the outright gift on anything that is important to you like a house. Look, if you have $50 million or $20 million and you want to give away a couple million and it doesn't affect your lifestyle, that's fine. But when it comes to the house you're living in, you need to be careful. There's a technique called a life estate where you transfer the house and retain the right to live in it for life. We don't use this, but it does come up occasionally, and sometimes people come in with it. These are still usable techniques for Medicaid. This is a timeline, meaning, so I give the house to my kids, I retain the right to live in it for my life. So now I own it for my life, they own it on my death. But if I want to sell it during my lifetime, part of the proceeds comes to me, part of it comes to them. Capital gain exclusion only applies to my part, not to their part. Then my part, not protected for Medicaid purposes. It's a mess. So these work really well if you're going to keep the house until the person dies. And so I had one case that I talk about where I had somebody that had a house that had been in the family for 3 generations, and so they used this, right? But we try to stay away from this. The irrevocable trust is the one that we really use frequently, probably a couple times a week. And so the irrevocable trust, yes, it's irrevocable, and that means that the person creating it can't revoke it, okay? That doesn't mean they can't change it. And that doesn't mean it can't be revoked under certain circumstances. It just means them by themselves can't revoke it. So typically the irrevocable trust that we use says, mom and dad create the trust, appoint the kid as a trustee. They retain the right to remove the trustee anytime they want. They name the kids as beneficiaries or trust for the kids. They can change that anytime they want. And they retain the right to live in the house. And sometimes they retain the right to income. The trustee is given the power to take assets out of the trust, give it to the kids, who then can give it back to the parents if need be. Or if we really want to get assets back to the parents, we can, with the parents, with one or more of the beneficiaries, we can revoke the trust, right? So you have a lot of control. I mean, we sit at the table and we say to the kids, listen, mom and dad are putting assets in here. If you don't listen to them, they're going to remove you as trustee. They're going to cut you out, and they don't have to tell you. They can call me and say, cut them out, right? Then I call you and say, whatever mom and dad asked you to do it because they're cutting you out. So there's a lot of control here. The nice thing about these trusts is it starts the 5-year look back for Medicaid. They trigger the grantor trust rules we talked about before. So from a tax point of view, mom and dad are still considered the owner. So they keep the exemptions, they keep the capital gain exclusion, keep the step up in basis, and it's asset protected from all creditors, right? So you put the house, I had a client who put their home in a trust and years later drove through a 7-Eleven, hadn't paid her homeowner's insurance, had to pay her car insurance. It was not a good situation, but the assets in the trust were protected, right? So it's an asset protection trust. The other thing about these trusts is they avoid probate, so that on death, you don't have to first go to a court, have somebody appointed, and then administer the estate. You can, upon death, shortly after, be administering the property right away. Okay. I hope that was helpful. Last slide. I like this. A lot of people get confused between irrevocable and revocable trusts for Medicaid planning. If you're using a revocable trust in the Medicaid world, it doesn't start the 5-year look back, and it doesn't protect the assets. It's a revocable trust. The assets in it are completely available for Medicaid purposes. It has to be an irrevocable trust. And so this slide sometimes helps create clarity for people. Okay, so thank you. I hope this was helpful. We're available for consultation. I told you I was going to brag about my staff. I have the best staff. Susan, who is on this today, has been with me 7 years now. And prior to that, spent 15, 20 years in the field. She did Medicaid applications for a group of nursing homes. We have a woman on staff who has her master's in social work, was the director of social work group of nursing homes. We have an attorney on staff who is a nurse and attorney, actually teaches in the Stony Brook nursing program. We have a former estate and gift tax agent. We have a gentleman who is an IRS appeals officer. We have great staff. Everybody comes to the table with a lot of experience, all focused on how we can help families protect their independence, dignity, and control. We try to make our planning easy for families, and we're available to our clients. So we don't charge for follow-up questions. We have clients call us, frequently to ask questions, tax time, whatever, and we always make ourselves available for that, and anything else that we can do to assist. I thank you for your attention, your time this morning. Thank you for having me today. And I'm going to just take 2 minutes, if that's okay.
Sure. So, David, we have a couple questions, if that's okay.
Yeah, just give me 2 minutes. I'll be right back.
Okay. So while David's gone, let me preemptively thank everyone for coming. He's going to come back and answer a couple of questions, but I really want to thank everyone for coming. This very informative session on elder law and estate planning. As a reminder, we'll be sending out a recording of the webinar along with David's contact information in the next day or so. So if you have any follow-up questions specific to your situation for him or even outside of your own situation, you can reach out. And of course, if you're interested in how making a charitable gift to Stony Brook can help you make a bigger impact than you ever thought possible, we'd love to hear from you. Whether it's through your state, charitable trust, or other giving strategies, our team's here to help you align your philanthropy with your goal. All right. Thanks again. And when David comes back, we'll answer the 2 or 3 questions we had.
Okay,
All right. Welcome back.
thank you.
We have a couple of questions here. The first one is, are people allowed to make you the beneficiary of a trust without your consent?
Wow, that's a first time question. The answer is yeah.
All
They
right.
can- yeah,
That's right.
yeah, that's a great question. Interesting. Thank
So
you for that question.
you mentioned IRA QCDs and that you had to be over 70 and a half, and then it counted as an RMD if 73. If you inherited an IRA and you're over 70 and a half, can it also count as an RMD for an inherited IRA?
Yes.
Okay,
Yeah.
great. And then this one's a little more technical and it may be outside the scope of this, but if you and your spouse are applying for or need nursing home care and you're thinking of a mix of assets, do you have a sense of which assets are best if you have a pension, IRA, a house, or a stock portfolio to
To do what with?
I guess to pay for it? I think.
Okay.
Trello.
Yeah. Great questions. Um, that's a very fact specific question. Let me just say, right? So when we're thinking about how we're going to pay um, a medical expense, we consider the tax impact and where to take it from, and which assets are appropriate. Retirement plan, if you can, without any challenges, and that's something we would typically do with the financial advisor, and potentially with the accountant, right, to identify. But that's a good question. That's why I highlighted for my mom. I'm using her IRA because I get, you know, it, I know that her IRA is going to be subject to income tax, right? Um, and so if I use it now to pay for her nursing home, I effectively make it tax-free as compared to using assets outside the IRA. I would still get the medical deduction if I use the assets outside the IRA, right? But the IRA is still going to be hanging around subject to tax someday. So I may as well, in her situation, it made perfect sense to use her IRA. Um, and from an estate planning perspective, the IRA is probably the last asset you want to inherit because you're going to pay income tax on it, maybe subject to estate tax. Last year, we had a client who had a significant estate and he had IRA money. And so here's a sophisticated tax concept, right? The IRA or the retirement plan that he had was $2.5 million. And let's just say his estate tax bracket was 50%, right? Just to make the math easy. So on his death, $1 million of tax would be paid to protect that $2 million IRA, which we know has 40% of it is going to go in income tax. So the technique we used was we rolled that IRA, excuse me, we rolled that IRA into a Roth IRA, paid the income tax, saved the estate tax, and now that Roth IRA grows tax-free as long as it stays in it for 5 years. The kids get it tax-free, and the kids can continue a Roth IRA for the same 10-year window after death, tax-free. So that was kind of a fun thing to do. Home run. By the way, Roth IRAs don't have a required minimum distribution for the owner, but they do for the beneficiaries. So
Great, great. Last 2 questions. Am I required to name my spouse as the beneficiary of a retirement account, or can I name my children instead?
You need your spouse's consent to name your children and not your spouse.
Perfect.
So you can, I'll say it differently. You can name your kids, but your spouse can challenge it.
Perfect. And the last question I think is for someone who's never worked with an estate planning attorney before, what's the initial consultation fee, or sort of what are you looking at from a cost from just an initial conversation with someone like yourself?
So I'm happy to, if they want to reach out to, if you're interested in that, I would suggest reach out to our office. We'll talk to you about fees. I don't like to talk about fees during these webinars. So with all due respect, we're happy to discuss that offline. Yeah.
Great. Well, that's everything. We thank you. I know you went significantly over your time with us today, and we appreciate
Sorry.
it. It was everyone here was glued to our screens and really appreciate the information. So thank you, David, and thank you to everyone who attended today.
Sorry I went over.
Not a problem.
Okay.
We all enjoyed it. Thank you. Take care, everyone.